Welcome to our comprehensive guide on auditing. Whether you're a student, a new auditor, or just someone interested in understanding more about financial scrutiny, this video is for you. Auditing refers to the systematic examination and evaluation of an organization's financial records. It's conducted to ensure that the financial statements are accurate and comply with any applicable laws and regulations. The primary objectives of an audit include ensuring the accuracy of financial statements, detecting fraud, ensuring compliance with laws and regulations, and evaluating the efficiency of an organization's operations. Let's take a closer look at different types of audits. Audits can be categorized into internal and external audits. Internal audits are conducted by employees within the organization to assess internal controls, risk management, and corporate governance processes. External audits, on the other hand, are performed by independent auditors. They provide an unbiased opinion on the organization's financial statements. Now, let's delve into the auditing process. The auditing process generally comprises 6 steps: planning, risk assessment, internal control evaluation, evidence collection, reporting, and follow-up. The first phase is planning, where auditors develop an audit plan based on the scope and objectives of the audit. Next is risk assessment, where auditors identify any potential risks that could affect the organization's financial statements. During the internal control evaluation phase, auditors assess the effectiveness of the company's internal controls. In the evidence collection phase, auditors gather evidence to support their evaluation. This may include techniques such as interviews, observations, and document reviews. After collecting evidence, auditors compile their findings in a report. This reporting phase culminates with the presentation of the audit report to the stakeholders. Finally, the follow-up phase ensures that any issues identified in the audit are addressed satisfactorily. Let's discuss some common audit techniques used during the evidence collection phase. These include substantive testing, analytical procedures, and compliance testing. Substantive testing involves directly examining transactions and balances to verify accuracy. For example, verifying a company's bank reconciliation statement. Analytical procedures involve comparing financial data to identify any unusual trends or patterns. For instance, an unusually high expense ratio might indicate potential fraud. Compliance testing checks whether the organization complies with relevant laws, regulations, and internal policies. For example, ensuring that expenditure approvals follow the company's hierarchy policy. Understanding the role of auditors is crucial. Auditors must not only have a strong grasp of accounting principles, but also possess investigative skills and sound judgment. Auditors are expected to uphold high ethical standards, such as independence, integrity, objectivity, confidentiality, and professional competence. Let's go through a real-world example to solidify our understanding. Suppose XYZ company hires an external auditor to review their financial statements for the fiscal year. The auditor starts by planning and identifying key risk areas, such as revenue recognition. In the risk assessment phase, the auditor identifies that XYZ company has a high volume of cash transactions, which poses a risk of misstatement. During the internal control evaluation, the auditor checks the procedures for cash handling and finds them inadequate. During evidence collection, the auditor conducts substantive tests by confirming large cash receipts with bank statements. Analytical procedures are used to compare this year's cash receipts data with previous years. Finally, compliance tests check if transactions comply with regulatory requirements. After gathering evidence, the auditor prepares their report, outlining key findings such as inadequate cash handling procedures and discrepancies in cash receipts. The report is presented to XYZ company's management, who then implement changes. Questions to consider: why is auditor independence important? What risks are associated with high volumes of cash transactions? How can inadequate internal controls affect an audit's outcome? Now, let's review. We went over the definition of auditing, its objectives, types, and processes. We discussed common audit techniques and ethical standards for auditors. We also looked at a real-world example to see these concepts in action. Thank you for watching this comprehensive guide on auditing. Feel free to leave your questions in the comments. Until next time, happy learning!